What is going on, everyone? Another video, but this one's going to be a little bit different. I know I've been dishing out some videos of potential companies that I feel are going to be breaking through the market the next few years, and I'm still a firm believer in those, but I really want to circle back, especially with everything going on, the craziness in the market at times. We really need to make sure that our portfolios are safe, because in any given moment, something could happen, whether it's geopolitical or you just never know. It seems like nowadays anything can change the market for better or worse. So we always want to make sure that we're in a safe spot. So we're going to go through that. All right. So, one more time, just want to put the disclaimer up there. If you guys can just check that out real quick. I am not a financial advisor, but I'm here to help in any way that I can to open some doors if possible and open to feedback, more important. So, the breakdown that I have is actually going to be the one that you see right here. So, before we get into specific stocks, let me just move this real quick. Before we get into specific stocks, I want to look at the breakdown. So, I would, if my portfolio is 100%, let's say I'm just starting off with $1,000, right? Let's say I'm just starting investing and I have $1,000 in, or that I'm willing to put into my investment. So with that $1,000, the first thing that I would do if I'm starting is I would put it into an ETF, whether it be VOO, QQQ, or SPY SPY. The reason being is because this would be the least stressful thing, in my opinion, that you could do. VOO and SPY both track the S&P, which in my opinion is going to be the main indicator of how the markets go in the future. And QQQ is tracking tech. So, tech and the S&P are what I really look at. Of course, the Dow is very important as well, and value stocks are in there. But in terms of where I'm holding my portfolio, I'm going into more VOO, SPY, and QQQ. So I would put about $570 out of that $1,000 right away into one of them. Now, you might say, well, VOO, I believe, is almost exactly 570, maybe a little bit more right now. I can't afford that. Fractional shares, and I'll make another video about that. But on Fidelity or whatever brokerage you use, you can actually just put in the dollar amount that you want to buy, and it'll calculate the amount of shares that you can buy. You don't need to buy a full share anymore. I know it looks good to have, whole numbers, but it's not like that anymore. It's a different age of investing. So far, out of the $1,000, I would have 570 of it in an ETF of some sort. Now, there are cheaper ones out there, so it really is up to you to go do your own due diligence. But I would make sure you have one that either tracks the S&P or the NASDAQ, in my opinion. So then the next step would be to go to the blue chip. All right, so that would be what, about, that would give us about another 27 or 29%. So I'm not going to do the math, but I would say, okay, no, that'd be almost exactly half. So about two eighty, about 285. All right, so after the $570 in one of the ETFs, I'm just doing the math off the top of my head, guys. You would then put about $280 into one of your blue chip or dividend heavy stocks. Okay, so I would go into, and this is where you guys can definitely give me some feedback, right? Because I have Meta, Apple, Netflix, right, as some of the blue chips that I would put them into, right? You can call them the Magnificent Seven if you want. And then I also have SCHD and EPD for my high growth dividends. So let me know what you guys think. Maybe it's kind of double dipping, do you think, by going into Meta, Apple, if we're already going into VOO, QQQ? Open to feedback. And then, so that would be about $280 in the blue chip stocks, right? Directly. Again, you can buy fractional shares if you can't afford a full share. And then the last remaining money would go into what I call the preference, right? The flex. What do you think is hot? In my opinion, I think the AI scene is just not barely beginning, but it's still got a lot of room to move. And I think quantum is next up. And then defense security, I believe, is going to be big in the future as well. So any sort of stock that involves with either cybersecurity or national defense, I think is going to be, especially with AI, is going to be big. So just wanted to make this video for you guys. I know that was kind of just a couple of charts and whatnot and some information. Just let me know what you guys think. So again, here's how you can break up your portfolio: 57% into ETFs, about 29% into some sort of blue chip or dividends. You can have that passive income coming in as well. So make sure if you go into dividends that you check your yield percentage. What will you actually be getting back, right? But you also want to try to pick a dividend that, yes, you'll get the dividend, but the stock's actually going to grow as well, right? So maybe you look at something like AT&T, right? I'm not sure what you guys think about that. And then finally, for the last 14% roughly, you have your preference, right? Your flex. Where do you think, right? Maybe you think that I'm not sure, guys. Maybe oil and gas is something that you're still into, right? So you guys let me know what your flex is, all right? So, and let me know if you have any questions. Hopefully this helps, guys.